Welcome to the Ticker USA, your source for gold, Bitcoin, and global market updates. Today, we're investigating a massive, quiet shift happening right now in the financial world. We're looking into exactly why high net worth investors are aggressively dumping stocks.
What if some of the world's biggest investors are reducing their stock exposure while everyone else is buying? Is this a warning sign or simply smart portfolio management? Let's break it down.
Financial headlines have been flashing red for months now. Tech moguls and hedge fund giants are quietly, strategically unloading their equities. And when the ultra-wealthy simultaneously cash out billions of dollars, it immediately sparks panic. People start thinking, wait, do they know something we don't? Now, the mainstream narrative loves to scream panic selling and impending doom, mostly just to drive clicks. But institutional wealth management is entirely unemotional. What we're really seeing is smart portfolio management. It's about adjusting the sails before the wind gets rough, not just blindly abandoning ship.
Okay, let's dive into this. What is the actual data-driven motive behind this sell-off? Because the smart money definitely doesn't trade on gut feelings or emotional reactions. They react to very specific, measurable economic triggers.
There are 5 key pillars driving these multi-billion-dollar moves. We're talking historically high valuations, highly disciplined profit-taking, the undeniable need for diversification, shifting tax landscapes, and of course, broad global uncertainty. These are the exact metrics sitting on their dashboards right now. Take profit-taking, for example. When an asset rallies hundreds of percent, cashing out at the very top is just standard discipline. Think of it like taking your chips off the table after a massive winning streak, rather than predicting the casino is suddenly about to go bankrupt. It just makes sense.
And where exactly do those chips go? Well, selling expensive equities allows billionaires to rapidly funnel that newly liquidated wealth into alternative stores of value. We're talking about assets like gold and, increasingly, Bitcoin. This specific structure shields their massive portfolios from singular economic shocks.
But to really understand the macro picture here, we have to look at the biggest suspect in the room, and that's the Federal Reserve. You simply cannot analyze billionaire wealth moves without watching what the central bank is doing.
By manipulating interest rates, the Fed basically acts as the ultimate gravity for the stock market. When they change that gravitational pull, massive institutional portfolios literally have no choice but to adjust their weight accordingly.
It's a mechanical chain reaction. First, the Fed adjusts rates. Next, borrowing costs for businesses immediately change. And finally, stock valuations react directly to that brand new cost of capital. The smart money obsesses over exactly where we are in this cycle at all times. In fact, interest rates are the absolute #1 external factor driving this current wave of billionaire portfolio rebalancing. Think about it. When money is cheap to borrow, stocks soar. But when money gets expensive and rates rise, smart money naturally seeks safer, more reliable yields elsewhere. And this brings us to the 2 distinct economic outcomes that billionaires are currently hedging against. They build their portfolios to survive a massive tug-of-war between 2 entirely opposing market forces. Smart money is constantly weighing this dynamic. On one side, you have the resilience and fierce optimism of the current bull run, but on the other side, you have the flashing warning signs that traditionally precede a harsh economic contraction. And this brilliantly illustrates the tension. Current market valuations are absolutely towering over long-term historical averages. When stock prices detach this far from underlying earnings, smart money naturally shifts into a protective stance. They are locking in gains right now simply because assets are historically expensive. Which leads us to a really vital question. Does all this economic uncertainty guarantee an immediate market crash? Absolutely not. For the everyday investor, it's critical to understand that uncertainty is a reason to prepare, not a reason to panic. The billionaires aren't panicking. They're coldly and logically adjusting. So how do we actually apply this? Let's pivot to what you can do right now to navigate these complex financial waters with the exact same clarity as the institutional giants. Consider this your personal financial dashboard. You need to monitor the Fed closely for rate shifts, review your own tax liabilities and potential capital gains, and check your portfolio today to ensure you aren't overexposed to highly overvalued stocks. This is exactly how you align your strategy with the smart money. To sum it all up, the core lessons are incredibly clear.
Watch the Fed, monitor those high valuations, and above all else, stay strategically diversified. Balancing your portfolio across stocks, gold, and Bitcoin is your absolute best defense against incoming market volatility.
So, we loop back to our original question. Is this billionaire sell-off a dire warning or simply smart portfolio management? Well, the data points clearly to the latter. It's highly calculated, disciplined management in the face of shifting economic tides.
The blueprints of the ultra-wealthy are entirely visible for those willing to pay attention to them. The only question left is, will you follow the smart money and structure your portfolio for what's coming, or will you be left blindly reacting to the market when the tide finally turns?
This is the Ticker USA. If you want to stay ahead of the market, subscribe now for the latest updates on gold, Bitcoin, inflation, and the global economy. Thanks for watching, and we'll see you in the next update.